Good afternoon, everyone, and welcome to the 6th webinar of our 2014 series, Insurance by the Numbers, where we're focusing on a different number each month from 0 through 10 and how those numbers impact your clients in the insurance world. This month we focus on the number 5 with the fuzzy math of annuity 5% guarantees and the difference between what your clients often hear and the reality of those guarantees. Today's presentation will last between 50 and 60 minutes, and you must be logged in for at least 50 minutes from the email address you registered with to qualify for CFP-CE credits. If you have questions as we go along today, feel free to ask them on screen, and we'll do our best to answer them timely and anonymously. This webinar is being recorded and will be posted to our website within a week. And now about your presenter. Today's presenter is Jerry Skapyak. Jerry's been in the insurance industry for more than 20 years now and is our in-house annuity and hybrids solutions expert. He's the go-to guy for advisors with clients seeking to ensure they don't outlive their savings. And now, in keeping with our number series, and so we can end at 5 today, let's get started with 5% guarantees and the fuzzy math. Here's Jerry.
Thank you, Dina. All right, so today we're going to talk about the fuzzy math of annuities. A lot of your clients have come into your offices and have brought in annuities, and they're told, I'm guaranteed some type of growth in it. So what we're going to do today is we're going to take some time and we're going to look at what does that 5% growth. And it typically deals with an income rider on the annuity. There's a guaranteed lifetime withdrawal benefit, a guaranteed minimum income benefit, and a guaranteed minimum withdrawal benefit. And that's kind of the fuzzy part. We're also going to take a look at a little clearer math, and we're going to take a look at some immediate annuities. But who should consider these riders? Well, why are your clients purchasing these annuities? Well, there's a variety of reasons. One, they want some guaranteed income. They've worked their whole lives, they've received a paycheck, and they still want to receive some guaranteed income. The guaranteed interest rate, they like seeing that they are guaranteed something. I'm guaranteed to get 5%. They like that. They want tax-deferred growth. Anybody who's buying an annuity should be looking to get that tax-deferred growth with the annuity. My favorite is the agent was nice. You know, they went, sat across from some nice young woman who talked very nicely to them, and they just had to buy from them because they were so nice. They got a free lunch. How many of your clients have told you that? Very popular with the equity index annuities. They go get a nice lunch, maybe at Ruth Chris or some of the other nicer steakhouses in the area, and they get that free lunch. They want a safe purchase, and that's kind of going back to the guarantees. But even though there's all of these all have really almost one thing in common for the client that's really getting them to buy these annuities, and it's fear. They're afraid of losing their money. They're afraid of the up and downs of the market. Here is a stock market chart showing all the peaks and valleys that we've seen over the last 14 years. You know, when the market's going like this, up like this, your clients aren't calling you. They're not bugging you. But if we come over here, 2008, 2009, when the market took the big dip, a lot of advisors got a lot of phone calls from clients. They were terrified. They were afraid of losing their money, afraid to invest. And especially in this downturn here, and then also kind of back here in the 2000s, there was a huge influx of sales into annuities that have these guaranteed income riders because they play on the client's fears as to why they should own these annuities. So when your clients are getting ready to retire, they have simple goals. They want monthly income. They've received that paycheck the whole life, and they want to continue to receive that income. As financial planners, you tell your clients their whole life to save, 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 and don't spend. And then when they get to retirement, now you're starting to tell them, well, it's okay to spend some of your money. Well, some clients have a hard time with that. Also, what they want is they want to sleep at night. They want to know that they're going to receive that income no matter what's going on with the market. So we're going to talk about these income riders. The Guaranteed Lifetime Withdrawal Benefit, I'm going to refer to as the GLWB, Guaranteed Minimum Income Benefit, the GMIB, and the Guaranteed Minimum Withdrawal Benefit, or the GMWB. And we're also going to touch on single premium immediate annuities. So when we're talking about income riders on annuities, there's something we need to understand first. There's two account values on the annuities. The first is their actual cash account, the account value, their real money. This is the money that they can spend. If they're going to surrender the annuity, this is what they're going to get. Then there's this other value, the benefit base. I call it the funny money. It's just a number on the statement, and it is nothing more. It is used to calculate some stuff, but it's nothing they can really spend. So your clients are coming into your office, and they're telling you, I'm guaranteed to get 5%, 6%, 7%, 10%. What does that really mean to them? Well, it's some interest they're going to be credited on their annuity. So let's talk about Sam. Sam wants to invest $100,000 into annuity, and he's being told he's guaranteed 5%. We're going to use this example that we're going to go through right now. We're going to use it over the 3 different income riders we're going to talk about. But for the most part, all of the income riders were kind of the same as far as accumulating wealth with them. So Sam wants to invest $100,000 into this annuity, and he's guaranteed to get 5% growth. In year 1, or at the end of year 1, his account value has grown to $103,000. He's gotten 3% on his money, but he's being told he can get 5%. What's going to grow at 5% is the benefit base, or what I call the funny money. Oops, sorry, wrong way. So his benefit base is going to be worth $105,000 at the end of year 1. Account value is 103, benefit base is 105. And the year 2 comes along, the annuity does great. It grows to $120,000. His benefit base is still guaranteed to grow at that 5%, so it's going to be worth $110,000. Now, one of the nice features with these income riders is they have a feature called a step-up feature. And what that says is that on a policy anniversary, now that anniversary can be annual, could be quarterly, could be monthly. There's even an annuity out there that does it on a daily basis. But we're going to use annual in our example. So on a policy anniversary, if our account value is greater than our benefit base is not going to be worth $110,000. It will actually step up to equal the $120,000. So at the end of year 2, both our account value and our benefit base are both worth $120,000. Year 3 comes along, annuity's performance is not so great. Account value goes down to $80,000. But the benefit base is still guaranteed to grow by that 5%, so it's going to be worth $126,000. Now we're going to really focus on this end of year 3 in our examples. So Sam wants to take his money and run from this annuity. What can he do? Does he get his $80,000 or does he get his $126,000? Well, he doesn't get the $126,000. He gets the $80,000 if he wants to take his money out of the annuity and go spend it elsewhere. The only thing the $126,000 is used for is to calculate income on the annuity. So now we're going to change gears a little bit, and we're going to talk about these riders in a little bit more detail. The 2 most common forms of these income riders are the GLWB and the GMIB. We will touch base a little bit on the GMWB. First, let's talk about the GLWB, the Guaranteed Lifetime Withdrawal Benefit. With this rider, it's very important to understand that it is a withdrawal benefit. So we're actually going to withdraw money out of the annuity. We are not annuitizing the annuity. When you annuitize an annuity, you are handing over the money to the insurance company, and in return you receive a monthly income from that annuity. It's like buying an immediate annuity when you annuitize an annuity. But this rider is a withdrawal benefit, so we're able to withdraw money out of the annuity. Now, how much you can withdraw, you know, it varies by insurance company, but typically there's a step on it. And it depends on how old you are when you take that first withdrawal. So Sam, who bought this annuity when he was younger, and he's going to start taking income out at age 70. So he's going to be able to withdraw 5.25% for the rest of his life. So what this does, if we go back to our example, his account value is $80,000 and his benefit base is $126,000. So Sam is going to be able to withdraw 5.25% of the $126,000, which is going to give him $6,615 a year. But you got to remember, with these riders, you don't get both. You don't get to take advantage of that benefit base, get that 5.25%. That's going to give you the $6,615, and you can't decide later on that you want to take more than that 5.25% out of that annuity. You can't have both. You can't have the account value, and you cannot have the benefit base. Now, I want you to remember the $6,615 because we are going to refer back to that later on. So when we're looking at the annuity, at the end of year 3, our account value is $80,000 and our benefit base is $126,000. If Sam starts withdrawing his money from the annuity, it's going to reduce his account value dollar for dollar. His benefit base stays level at the $126,000. As long as Sam never takes any more than what he's allowed, in our example, the 5.25%, his benefit base is going to stay level at the $126,000. So Sam withdraws the $6,615, and we get down here to year 15. He's left with $620. Oops, sorry about that. And we get to year 16. He's withdrawn all of his account value, but he continues to receive the income. And in fact, he'll continue to receive the $6,615 for as long as he is alive. So one of the selling features that are sold to clients when they purchase this is that because it is a withdrawal benefit, they still have access to that money. Sam does have access to that $80,000, and he can withdraw that money at any time he wants or any portion of it he wants. But what happens if Sam withdraws more than what he's allowed? So let's take a look at that. So Sam, he does have access to his account value. He has access to that $80,000. Well, let's say Sam wants to withdraw $40,000 of it. Any withdrawals over what you're allowed are going to reduce the different values in the annuity proportionally. So in our example, Sam's going to withdraw 50% of his account value. He's going to take out $40,000. You know, he was driving down the road by the car lot, saw that new Lexus, and he decides, you know what, I've worked my whole life, I want to buy that car. So he's going to take $40,000 out of the bank and put it down on that Lexus. And he can do that. He has a right to do that with his annuity. But it's going to come at a cost, because what happens is his account value is reduced dollar for dollar down to $40,000, and his benefit base is reduced proportionally. So his benefit base is also reduced by 50%. We're taking 50% of the account value out. We're going to reduce that benefit base down to 50%. So how does that affect Sam's future withdrawals? Well, he was taking out $6,615. But what happens, since we're taking $40,000 out in that first year, his withdrawals in the future are going to be reduced down to $3,308. And then that will continue for the rest of his life as long as he doesn't take out any additional funds. So Maria, this is an actual client that has purchased an annuity through us. She purchased her annuity in 2007. What she actually did, she actually had an annuity that was much higher cost, and we do what we call an annuity rescue. We did a 1035 exchange from that annuity into a lower cost annuity. She had approximately $580,000 in her annuity when we moved it over in 2007. And she was concerned about needing income in the future, so she added on the GLWB rider to the annuity. So 2009 comes along. Her account value had shrunk down to $420,000, but her benefit base was $710,000. So now you're probably wondering, she put in $580,000, her account value went to $420,000, but her benefit base was $710,000. Well, she got into that annuity kind of at the biggest up run in the market, and she had a couple of policy anniversaries in there that locked in those gains with that step up. So what happened in 2009, she wanted to start taking withdrawals out of that annuity, and she was able to withdraw 6% of the $710,000, which gave her $42,600 a year. That was much better than if she had just her account value, and if she was going to be able to withdraw 6% of it, she would have only gotten a little over $25,000. So in her case, she bought in at the right time. Because of those step-ups, she's able to get $42,000 a year. And she's continuing to do that today. Now let's move on to the second rider, the Guaranteed Minimum Income Benefit. Well, with this rider, it has two parts. The first part works just like the Guaranteed Lifetime Withdrawal, except instead of having your amount you can withdraw based on the age of that first withdrawal, how we had different steps, what this rider says, no matter when you start taking withdrawals, you're going to get 5% for life. And actually, this rider is primarily used by one insurance company. Their mascot is Snoopy. I'm sure you probably know who I'm talking about. This is what a majority of their income riders are on their annuities. So with this rider, you can withdraw 5% for life. But it does have a second part, and you can annuitize that benefit base. So they have a withdrawal benefit, and then they have annuitization benefit. Remember, when we see the word annuitize or annuitization, we got to give up control of the money in that annuity, and we no longer have access to the account value. So for option one, the Guaranteed Lifetime Withdrawal Benefit part of the rider, Sam, go back to our example, at the end of year 3, his account value is $80,000, and his benefit base is $126,000. He's going to get 5% of that benefit base, which is going to give him $6,300. Once again, remember that $6,300 for the GMIB option one. We're going to refer back to that in a little bit. But option two is an annuitization benefit, and Sam would have to wait to age 70 to annuitize. So basically, what this rider does, it forces you to wait. If you want to use the annuitization part, they force you to wait 10 years before you can annuitize that benefit base. And if you take advantage of a step-up in any one of those 10 years in that waiting period, it starts a new 10-year waiting period if you want to annuitize. They also have, once you annuitize, they call it an age setback. And what this means is that, for example, if Sam is going to annuitize his annuity at age 70, they do a 10-year age setback. meaning that they're going to make Sam age 60 when they calculate his income on the annuitization portion. Also, in order to see what the payout is going to be under the GMIB option 2 portion, is really going to have to, the client's going to really have to call the insurance company to see what it is they're going to get. So Sam, when we're looking at this, back to our example, 80,000 account value, 126,000 benefit base. His annual income, and this is from an actual client, his annual income is going to be right around $7,056 a year. And that's what he would get if he annuitized it. So here we have Norm. Client's actual name, he had purchased an annuity with $135,000, and he had the GMIB benefit on it. 11 years later, his account value had grown to $212,000, and his benefit base has grown to $253,000. Now, under normal circumstances, you think, well, the benefit base is greater than the account value. It's a good deal for this client if they want to start taking income. But you got to remember, with the GMIB and the annuitization portion of it, there's that 10-year age setback when you go to annuitize it. So his GMIB was going to provide him income of $1,213. The advisor had called me and just said, you know what, is there something better we can do? I just want to double check before I give the client the okay to go ahead and activate this part of the rider. Well, what I did is I took that account value of $212,000 and ran it through the companies we work with for immediate annuities to see what type of income I could get him. And I was actually to get him over $100 more per month by purchasing an immediate annuity. So kind of the moral of the story is if you have a client who's getting ready to turn on the income from one of these income riders, give me a call and check with me. Let me see if there's something better out there for your client. It may be best just sticking with that annuity. It may be better going somewhere else. In this client's example, it was better for him to purchase an immediate annuity with the account value of $212,000. Okay, I have a question here, and it says, with the guaranteed lifetime withdrawal benefit, what happens if the person dies shortly after starting the withdrawals? That is a great question. Since it is a withdrawal benefit, whatever the cash value in the annuity is would pass on to the beneficiary. Now, for some reason, the cash value was less than the premiums paid. The death benefit to the beneficiary would be whatever the death benefit is. Let's see, I got another question here. When the client starts drawing income of the guaranteed lifetime withdrawal benefit, does the benefit base stop growing at the 5%? Yes, it does. Once you start taking withdrawals with any of these income riders, any guaranteed growth stops. Now, you could still receive the step-up, meaning that on a policy anniversary, if the account value is greater than the benefit base on a policy anniversary, you still could receive a step-up, and you still could receive then more income because the income's based on a higher benefit base. Next question, no surrender fees with that example. Yes, I'm ignoring all surrender charges in these examples and any fees that may be associated with the annuities. This is purely for illustrative purposes to give everybody an understanding of the basics of how these riders work. All right. Okay, so I got another question here. So unlike the guaranteed lifetime withdrawal benefit, once you annuitize the GMIB, there would be no death benefit. And that is absolutely correct, because remember, when you annuitize an annuity, you're turning over the account value of that annuity to the insurance company to receive an income stream. So therefore, there would be no death benefit. Okay. Another question here. All right. I am being told I need to keep moving along. We'll get to some of these questions at the end. Now let's talk about the guaranteed minimum withdrawal benefit. Not very popular anymore. This is more, you may see clients come into your office with this rider on their annuity. All right, so what does the guaranteed withdrawal benefit do? Well, it's going to guarantee Sam that he's going to get back the greater of his principal paid or his benefit base. And it says he can withdraw up to 7% of that benefit base per year. But with this rider, there is no lifetime guaranteed income, and there's no guaranteed 5% growth. So let's go back to our example. We have Sam. He's investing his $100,000 in this annuity, and at the end of year one, his account value has grown to $103,000. Since we don't have the guaranteed 5% growth, Sam's benefit base is going to be equal to the $103,000. Year two, his account value grows to $120,000, so his benefit base will step up to equal that account value of $120,000. Year three, where the annuity didn't do so well and the account value went to $80,000, his benefit base actually stays at the $120,000 since there is no guaranteed growth. So in this example, Sam can withdraw 7% of the $120,000, so he can take the $8,400 out of that annuity. But since it is not a lifetime withdrawal benefit, and using the rule of 72, he's going to be able to withdraw the $8,400 for about 14.2 years. That's when the $8,400, actually we got an example here. So Sam's going to be withdrawing his $8,400 out of the annuity, and here we got our cumulative withdrawal. And he keeps taking it out, and it's going to reduce his account value dollar for dollar. So we come out here to year 5. It's actually his second year of withdrawals. His cumulative withdrawal is $16,800. His account value is down to $63,200. Get down to year 12 of the annuity, or which is actually about the 7th year almost of his withdrawals. He's still withdrawing the $8,400. His account cumulative withdrawal is now $75,600, but his account value is down to $4,400. Now Sam still, even though he only got $4,400 of his account value, still gets to withdraw the $8,400 out of the annuity, and until he gets to withdraw that until his cumulative withdrawals equals $120,000. At that point, with the guaranteed minimum withdrawal benefit, that's when the annuity ends. So in our example, yeah, it was better than if he didn't have any rider on the annuity, because he only would have got $80,000 out of the annuity. At least with this rider, he was able to withdraw $120,000 out of it, but does not provide lifetime income. As I said, I really don't see this rider being sold very much anymore. You're going to see it more of a client that has an older annuity coming into your office with it. The safe withdrawal rate versus income riders. As financial advisors, I know most advisors do not like annuities, and I fully understand that. But I just want to go through an example here. In year 3, in our example, our account value is reduced down to $80,000. Now, if the client was invested in similar investments that were inside that annuity, their account value would have functioned or moved up and down very similar to what the annuity did. Now, it would have been a little higher than $80,000 because we don't have the fees of some of the annuities going with it, but it still would have been lower. To keep things simple, I'm just going to stick with the $80,000 because that's what we've kind of talked about. So for Sam, I'm told by a lot of financial advisors, the safe withdrawal rate is going to be about 4.5% for him. which is going to give him annual withdrawal of around $3,600. With the client, the safe withdrawal rate of $3,600, he's going to be able to take out, but there's no guarantees on that. There's no guarantee how long he's going to be able to withdraw that money. When we look at the other riders, and this is where I was kind of saying remember those numbers because we're going to see them again, our guaranteed lifetime withdrawal benefit, client would get $6,615. The GMIB, client gets a little less income, $6,300. Both of those are guaranteed for lifetime. And if by chance the client had the guaranteed minimum withdrawal benefit, he would be able to withdraw the $8,400. And remember, he's going to be able to do that for 14.2 years, giving him $120,000 worth of income. Now, if this was proposed to clients, which option would you prefer? They're probably going to prefer one of the options with the income rider. And this goes back to now down in the beginning of the presentation where I talked about why are clients buying these? It's the fear they have of losing money and getting income that is guaranteed for life. It's examples like this. Client would much rather receive over $6,000 worth of income than receive, less than $4,000. All right. Moving on, who should purchase living benefit riders? Well, it should be clients who want guaranteed income. There's no other reason why anybody would buy an annuity with this rider if they did not want guaranteed income. They have older annuities or life insurance. When we say life insurance, they no longer have a need for that life insurance, but it's permanent insurance and they have cash values in it. We could transfer that into annuity and guarantee them some income with it. They don't have time to recover if the market fails. This is going back to the fear factor of clients that they have about losing money. This is a way you can put the money in. You're going to lock it in. With that benefit base, you're also going to lock in that death benefit on the annuity, that if something happens, that they're guaranteed at least somebody's going to get something with that money. They want to lock in that gain. Or they want insurance on an equity position. That is what these income riders are. They're buying insurance on an equity position that is going to guarantee them some income that they can get. So now we're going to change gears a little bit, and we're going to talk about single premium immediate annuities. So we've kind of talked about the fuzzy math of annuities. If clients really aren't sure exactly what they're getting, how that guaranteed income works, what's guaranteed at 5%, a lot of clients don't really understand that. I can't tell you how many times even advisors call me and tell me the client says they're guaranteed to get 5%. And the client doesn't understand that it's not on the account value. So now we're going to talk about the not so fuzzy math. We're going to take a look at income annuities. Much clearer, much simpler products. So with an immediate annuity, we're looking at them because they provide guaranteed income and they have several different payout options or several ways in which the client can receive income. They can either receive income over a set period or a period certain, or they can receive payments over their lifetime. So let's first talk about the period certain. What's typical is you can pick a period certain from anywhere from 5 to 30 years. Those payments will continue for that set period whether the client is alive or not. If the client passes away, the payments continue on to a beneficiary. Where we see period certain used often, clients that are getting ready to retire. Say you have a client who's 62, wants to retire, but you want them to wait to get Social Security. So we've done several where we'll look at a 5-year period certain the client will purchase to cover that gap until they reach age 67 and can receive that higher income from Social Security. Lifetime payouts. This is the more common type of payouts that we see with with immediate annuities. Lifetime payout is going to pay for as long as that client's alive. Once they pass away, payments stop. Provides the highest guaranteed income out of any product that is available. Life with a period certain is going to pay for the life of the client or the length of the period certain, whichever is greater. So for example, say the client purchases a life and a 10-year period certain annuity. The client passes away after 8 years of receiving payments. Payments are going to continue to the beneficiary for the next 2 years, fulfilling that 10-year period certain part of the annuity, and then payments stop. If the client passed away, say for example, after receiving 15 years of payments, he's exceeded the period certain period, and the annuity would stop. My favorite two options are the life with installment refund and life with cash refund option. These options guarantee that the annuity is going to pay out at a minimum the premium that was paid in. This is great. A lot of clients say, well, why would I want to buy an immediate annuity? If I die tomorrow, I lose the money. Well, when you're looking at these type of payout options, you're not going to lose that. The annuity is going to guarantee it's going to pay it out. So let's use an example. Client puts in $100,000 into the annuity, and he passes away after receiving $75,000 in income. The installment refund option will continue to make payments to their beneficiary until that other $25,000 has been paid out, fulfilling that $100,000 of the installment part. The cash refund annuity, instead of continuing payments to the beneficiary, is just going to write a lump sum check for $25,000 to that beneficiary. Now, of course, the annuity can continue for life, so if the clients received more than $100,000 in payments, the annuity would have stopped at that time. We can also add on a spouse to the annuity, and we can pick any one of these payout options and do it with the spouse. We can also, either upon one of their deaths, have the full payment continue to that spouse, or we can have the payment reduced. Anytime you have a payment that's going to reduce to the spouse, the initial payment's going to be higher. Anytime we add on any guarantee, that's going to reduce the payment. We can also add on cost of living adjustments to any one of these payments. The most common is an increasing payout option. We can have that payment increase by anywhere from 1% to 5% every year. Of course, simply by just adding an increasing payout option is going to reduce the payments. And also, the greater the COLA option that's selected, so if we choose like 5% over 3%, the payouts are going to start lower also. There are also a couple of annuities that offer inflation that is indexed to CPIU, not CPI, it's a subset, CPIU. And as I said, there's only a couple of companies. Normally don't really recommend this option because there are so few companies to look at for it. Anytime I do any talk on annuities, I'm always asked, what are current payouts? And here they are. So what I looked at was a $100,000 premium going into an immediate annuity for male age 65. That's going to produce about $563 a month. Female, $527 a month. Why is the female lower? Because they're going to live longer on average than a male. So their payouts are a little bit lower. And then if we're looking at a joint couple, both age 65, their payouts are going to be lower yet, $470 a month. I'm often asked, well, what is the crediting interest rate that immediate annuities are paying? Well, that's one thing insurance companies do not publicize, is what the crediting rate is. But if you can tell me when your clients are going to die, I can tell you what the rate of return is going to be. What I used here was life expectancy, which is roughly for the male and female right around age 85. And for the joint couple, it's actually going to push it up closer to around 90, 91 for the life expectancy. And as you can see, for a male, the rate of return is going to be just under 4%, the female about 3.22. The longer the client lives, the greater that rate of return is going to be. Now, this is based on life expectancy. When you have a client that is considering immediate annuities, they should be in good health. They should be in better health. One, the insurance company is already assuming they're above average health, they're above a standard risk, and you want your clients to be alive a long time to take advantage of receiving those payments. So probably the most common question I get asked right now with immediate annuities is to wait or not to wait to buy them. So let's go through an example. Sam, who is age 65, should he buy his immediate annuity today, or should he wait till he turns 70? Well, the question is really, how much do interest rates have to increase in order for Sam to break even? So Sam's going to put in $100,000, and we're going to look just at a life-only payout. So today, at age 65, that $100,000 for Sam is going to give him $7,042 a year in income. If Sam waits to age 70 to buy that same annuity, and we're assuming today's interest rates, he would get about $1,000 more a year, $998 to be exact, in income. And a lot of people see that and think, well, heck,
we seem to be having some audio troubles. If you all can hear me now, if someone would type in a response to let me know you can hear me, that would be great. Oh, okay. I hear we're back. Just a moment. We're going to have Jerry switch computers. Just a moment. Thanks for holding with us.
Sorry about that, everybody. We're not sure what happened here. I saw we did get a bunch of questions in, and we will get back to them. If someone, I'm assuming everybody can see my screen. If you cannot see the screen, let me know. You could type a message in. All right. All right, so let me continue where we are. I apologize, I'm not exactly sure where the audio cut out, but so we have Sam here who is trying to decide should he wait or not wait to buy an immediate annuity. So at age 70, his income on an annual basis would be $8,040, about $998 higher than if he bought at age 65. And a lot of people would think that's great, we're going to wait to buy the annuity. But what a lot of people don't take into account is that income that is lost over those 5 years by not taking the income at age 65. And in fact, Sam would have missed out on a little over $35,000 by not taking the income. So as you can see, if he waits to age 70, getting $1,000 more a month, it's going to take him roughly 35 years to just break even. And that's going to put him out somewhere around age 105 to break even. But the question is, how much do rates have to increase in order to break even? Sorry, I'm on another computer, and for some reason I can't control my slides from here. So I apologize to everybody for this. All right, so from talking to some actuaries in a home office, what I was told is that at age 65, for every $100,000 in premium, the yield curve would have to shift about 10 basis points, or every 10 basis point shift in the yield curve equals $60 a year in payouts. That could be either up or down depending on how the payouts go. All right, Dina, next slide. And using this, interest rates would need to increase about 1.4% over those 5 years in order for the client to break even at age 85. So when it comes down to it, should Sam wait or should Sam not wait to buy the immediate annuity? He should really buy it whenever he needs that income, because none of us know what interest rates are going to do for sure. I've been in this market for 20 years. I've been working specifically with annuities for over 10 years. And literally since I've been working with annuities, it's been the same. Interest rates are going to be going up. They can't go any lower. They're at all-time lows, and they've actually remained here for quite a few years right now. So I don't know when rates are going to go up, but I would say for right now, when your clients need income, now's the right time to buy them. All right, Dina. All right, so who should purchase an immediate annuity? Well, of course, once again, it should be somebody who wants guaranteed income. They have old annuities or life insurance, because once again, we can take the cash value out of permanent life insurance and transfer it to an annuity, and if they need income at that time, we could definitely put it into an immediate annuity for them. They need income in the next 12 months. The reason I say the next 12 months is because an immediate annuity, that's when income has to start. Typical deferrals 1 month, and income has to start within 12 months for them. They want to lock in the gains. Once again, you know, if they got an annuity, they got some gains, they're getting ready to retire, we could transfer to immediate annuity and get them that guaranteed income that they really want in retirement. And the clients that are looking to purchase an immediate annuity tend to be on the conservative side. They're not really into taking much risk anymore, or maybe they never were much of a risk taker, but this will give them a nice conservative way to give them that guaranteed paycheck they want in retirement. All right, so what do your clients get with these guaranteed income products? One, they're going to feel comfortable in retirement, and they're going to feel like they are ready to retire. They're going to receive that monthly income that they want, that they're used to receiving. And they're going to sleep better at night. Comes down to, none of us really want the clients calling us all the time, worried about their money. The client truly just wants to sleep at night, know they have income coming in that they can spend. And then what does the advisor get? Well, you get to manage the rest of the portfolio a little bit more aggressively when you have guaranteed income in it. For those of you who have not done this, I encourage you that if you're using like Monte Carlo analysis or stochastic modeling, that next time you're figuring out the safe withdrawal rate for your clients, plug in some guaranteed income into it and see what it does. It's either going to increase your probability of success, or it's going to increase the amount they're going to be able to withdraw out of their portfolio. Your clients are going to get guaranteed income for life. Nobody really complains about that. Your projections are going to look a little bit better. It's kind of going back to the Monte Carlo simulation if you use that. And then finally, once again, your clients are going to sleep better at night with the guaranteed income. So did you know all right, we have several webinars that we're going to be doing. There's different groups that we'll be doing them for. The next one's going to be the NAFA Genesis group we'll be doing later on this month, and then we'll also be at the Garrett Retreat. And then some interesting facts. Typical annuity owner is a middle class person with annual household income around $64,000. The average annuity first purchase is purchased at the age of 51. It's very rare to see a client come in their 30s or 40s with an annuity. Most of them are waiting to their 50s to purchase them. And as you can see, females, slightly over males, are the ones who are purchasing the annuities. I think that goes back to they're probably a little bit more conservative. They want the guaranteed income, and they're simply looking for guarantees. And I'm going to, once again, I'm going to get to everybody's questions in just a minute here. And all right, so 10 things that make LLIS different. Well, one is we provide these monthly webinars that everybody has been so nice to take and give up an hour of their time today to attend. Our next one in August is going to be the top 6 reasons people want life insurance or permanent insurance. Number 2, we're not your competition. The only thing we do is offer insurance. We are not money managers. You are our only client, the fee-only financial advisor. We save you time and your clients money because we do a lot of pre-underwriting to help avoid surprises and place your clients with the appropriate company, hopefully the first time around. We probably sponsor a variety of groups: NAFA, Genesis, XY Planning Network, Alliance of Cambridge Planners, and also the Garrett Planning Network. We have product specialists. I am the annuity expert. We have disability and long-term care and life insurance product specialists in the office. For those of you who work with us, what we get tons of compliments on is our AIM system. It keeps you and the clients informed when they're going through the application process with an insurance company. Very few reasons why you would need to call us to see where a client is in the process, because you're receiving these updates, and in those updates it clearly labels how long each of the steps are going to take. And then finally, we manage your clients' policies both now and in the future. We're going to send emails out about a month ahead of time before their premiums are due. It's amazing how often clients move and never tell insurance companies. It's a great way we found that has stopped a lot of policies from lapsing simply because the clients moved. And we're also going to keep track of your clients' expiration dates of their term conversion options. We're going to let you know before they're going to expire, and we'll take and have a conversation about should they convert or not. All right, so let me get to some of these questions. I'll stay on here as long as needed, and some I may need to respond back on it. Any interesting developments in longevity space? The latest thing that's happened with that is the IRS has said that they're going to allow income to be started after age 70 and a half at those products. Still have not found any companies that have changed their software or are allowing it yet, but constantly looking into that to see. What benchmark rates drive annuity rates? For those of you who don't know, I actually came from a home office of an insurance company. And I would say kind of look at the 10-year Treasury. It's not going to be exact by any means, because insurance companies are out looking for whatever kind of fixed investments they can find to back the products. You know, sometimes insurance companies will get something that's really good, and we'll see them all of a sudden showing up as being the #1 company with interest rates. Got a question here. What are the current crediting rates on the SPIAs at age 65? That was actually the example we used in the presentation. Are the step-ups automatic on anniversary, or does the client need to opt in? He's referring back to the income riders. Most of the time, the step-ups are automatic, but not always. That really depends on the insurance company. Some insurance companies, you have to elect it, and then they're also going to tell you that when you elect the step-up, then it gives them the right to increase the fees for that rider. So it really depends. Let me see. Okay, I do not understand the rest of 10-year reset on anniversary of step-up. Can you explain? So what I think they're referring to is with the GMIB rider, the option 2 where you could annuitize it. With that rider, you have to wait 10 years before they'll allow you to annuitize that benefit base. You can always annuitize the account value anytime you want, but if you want to annuitize the benefit base, they require a 10-year wait. And when you have a step-up, you're increasing that benefit base, so therefore they're going to require another 10-year wait on it. Okay, can you clarify the tax implication on annuitization withdrawals versus GLWB, or other types of withdrawals. Okay, with a withdrawal benefit, anytime you withdraw money out of an annuity, you have to withdraw the gains first. So therefore, any gains in the annuity are going to be taxable. Once you've withdrawn all of the money out of the annuity, and in our example you saw our account values went down to 0, but the client continued to receive income. So once you withdraw all the gains out of the annuity, you're no longer taxed on that money until that account value hits 0, or in a sense you've withdrawn all your cost basis out of the annuity. At that point, it is all viewed as gains again and will be fully taxable to the client. Whereas if you annuitize an annuity, part of each payment is going to be part return of the original premium paid and part return of interest earned. Old life insurance policies often have income riders available. Could they be better than a SPIA bought separately? Should we always compare them with SPIA rates? Actually, anytime you're looking to annuitize an existing product, whether it be life insurance or an annuity, you should always get a quote from that insurance company, especially if it's older, because a lot of those products had guaranteed interest rates of 4%. And they're using older annuitization tables. So it's always worthwhile to get a quote on those older products from the insurance company. Already answered that. So unlike the GLWB, once you annuitize with the GMIB, there would be no death benefit. That is correct. Is a guaranteed income on the benefit base before or after fees? How do fees impact this? Okay, any fees that are charged for the income riders are deducted from the account value. They are not deducted from the benefit base at all. Okay. Sorry, sometimes there's questions I've already answered that are just asked a different way, so I'm trying to read through. GLWB, generally the recommended rider if one is chosen from your view? Yes. That's the rider that we use here when we have clients that are looking for it. Excuse me. So I definitely feel that is the better choice out of the riders that are available today. All right, I've kind of went through some of these involve a little bit more. So I'm going to end it now. If you have additional questions, feel free to give me a call tomorrow or email me. But I will get back to the questions, or get back to the advisors whose questions I didn't get to today on the phone call. Thank you, everybody, for attending, and have a great night.